Hello, and welcome to another MH webinar. Thank you so much for joining. We're going to wait just a few more seconds to allow other participants to log into the webinar. So again, thank you for joining us today. If you've just logged in, I want to thank you again for joining another MH webinar. Today's topic is discounts for lack of marketability and control in the real world. We have a few more participants logging in, so we're going to wait just another couple seconds and then I'll go ahead and talk about some housekeeping notes. As we get started here today, I just want to mention that if you are attending this webinar for CLE or CPE credit, please make sure to answer the attendance checks that will appear throughout today's session. This is one of the ways we will verify attendance. For those who are watching as a group, one designated person can answer the polls while we will verify those present following the webinar. Everyone attending today who has requested CLE or CPE credit will also receive email communication from Sue Kirkpatrick with instructions and documentation related to your CLE and CPE credit. Throughout the presentation, if you have questions, please use the Q&A button on your screen. Our team will monitor those throughout the session and will address the questions either as we go or during the Q&A portion at the end. We are recording the webinar today. A recording link and the slide deck are available to you upon request. Lastly, you will all receive a short survey following the webinar. Your feedback means a lot to us. It helps us shape future sessions and makes it possible for us to continue meeting the requirement to offer CLE and CPE credit for those attending. Today's topic is discounts for lack of marketability and control in the real world, data, judgment, and defensibility. We are going to go through a practical framework for evaluating these discounts in tax, litigation, negotiation, and trial settings. To set the stage, what is it that we're talking about here? What are the discounts for lack of control and lack of marketability, and how do they impact value? Well, if we have a company that's valued at $10 million and we need to value a minority interest that's not marketable, a discount for lack of control and marketability may apply. And in this case, you can see a 15% discount for lack of control and 25% discount for lack of marketability applied to that 10 million value results in a value of 6.375 million that would be prorated to the specific interest we're valuing. A small change in the discount assumptions can move the value by hundreds of thousands or even millions of dollars, depending on the situation. Our learning objectives today will be to, when you leave the webinar, for you to be able to identify when the DLOCs or DLOMs become outcome determinative in specific matters, how to recognize the factors that affect these discounts, evaluate the reliability of the valuation expert conclusions on discounts, and spot some common errors, be able to do some double checking on the math or the assumptions that are used in developing these discounts. The issue isn't usually whether discounts apply. The issue is typically, are the discounts reliable? Are they economically sound? And are they consistent with the methodologies as applied in the specific valuation? Discounts are often applied in valuations that are performed for these purposes. Estate and gift tax valuations, if we're valuing a minority interest, a discount for lack of control and lack of marketability would typically apply. The Internal Revenue Service is really looking for well-reasoned support for those discounts and not just using an average or median from empirical studies. The IRS has a job aid for valuation professionals that talks about the different ways of determining discounts. And in recent tax court cases, the judge is looking for more rigorous discount analysis. So this is really important in gift and estate tax situations. Now, in litigation settings, whether it's a shareholder dispute, divorce, a buy-sell agreement dispute, or oppression situation, we have to look a little bit more carefully at the standard of value, what the statutes require, and what the specific interest is that we're valuing. And then for settlement discussions, it's always important to look at a sensitivity analysis. So what happens if the discount moves 5% or 10%? How does that impact the conclusion of value? From an attorney's perspective, trying to identify issues before the valuation report is final is really important. And kind of looking at the discounts from a reliability perspective. So if the discounts change, how would that impact the case strategy or the value conclusion? Are there documents that support different rights and restrictions or transferability of the subject interest that maybe weren't considered in the report or weren't addressed in the valuation report relative to these discounts? And then test whether the expert matched the discounts with the methods used to value the subject interest. And we'll go into these in more detail as we get through the presentation. Look for unsupported averages. Like I mentioned with the gift and estate tax, the IRS does not want to see just the median or average discount from an empirical study. They want to see more rigorous analysis of the transactions in those studies and use of alternative empirical and qualitative and quantitative data. So the roadmap for our discounts is we're going to look at data, and that would be empirical evidence, so studies on discounts, as well as quantitative models. Judgment revolves around the qualitative analysis of the valuation specialist. And then the defensibility is how does the empirical evidence, the quantitative models, and the qualitative analysis all come together to support the concluded discount. The level of value is the starting point before we determine what discounts might apply. And so this is kind of the standard level of value chart where at the top is a strategic or synergistic value that typically exceeds a fair market value standard. And that's because it includes different adjustments for the buyer that are very specific to that buyer. The control standalone, this would be that control level value owning 100% of the business. That doesn't include any of those synergistic specific adjustments. A minority liquid level of value is like a publicly traded minority price. So it's liquid, but it isn't a controlling level. And then minority non-marketable, that applies to what we're typically are working with is a private minority interest. Now this is a little more detailed level of value presentation. And it's really helpful because we can see kind of the typical context when that level of value may apply and some of the key takeaways related to that level of value. So that control strategic, which you saw on the earlier slide, this could be either a private or a public buyer, but it is a specific buyer and it is unique to that specific buyer. And it includes synergies that another buyer may not have. So therefore, it is very buyer specific. The minority or control standalone liquid value, this is like the public market. And so even though minority shares are traded on the public market, the value of that public company on this control standalone basis would be determined by taking the shares outstanding times the stock price. The minority liquid value is the actively traded public shares. So there's usually no discount for lack of marketability or control adjustments. It just depends on the standard value and the interest that's being valued in the particular case. Now, where we are typically spend most of our time as valuation specialists is in the control standalone and the minority non-marketable level of value, because these are private companies without considering any synergies that a buyer may bring to the table. And so the control standalone, this is where we adjust all of the cash flow and use methodologies that arrive at a control level value. And a controlling owner can dictate the timing of a sale, the level of distributions, but there still may be some uncertainty relative to the price that may be able to be achieved in the sale. Now, minority non-marketable, this is where we really get into the details of our discounts for lack of control and lack of marketability. It really revolves around what rights does this interest have? And how does that impact the value of that interest on a minority non-marketable basis? And before we look at whether a discount is too high or too low, we need to have an understanding of the level of value that the valuation methodology produced. And that goes into what method was used, as well as any adjustments that were made prior to applying that method. So from a control perspective, if you own 100% of the company, you get to do what you want, right? You can make distributions as you choose. You can adjust compensation strategy, or make a strategic plan, acquire another company, or sell your company. You have control over the management team, and there's value in that. Marketability relates to the ability to take an interest and sell it. So is it sellable? Can you market the company and be able to find a buyer? Now, in a private company, that marketability, it still requires time and effort, and there is still uncertainty as to whether or not a buyer will actually be found. Now, liquidity and marketability are often, those terms can be used interchangeably, but they are a little bit different. Marketability is the ability to sell the interest. Liquidity is how quickly you can convert that interest to cash. And if you think about a controlling private company, that might be marketable, but it's not liquid. It can't be converted to cash in a short period of time. So the discount for lack of control, it's really about evaluating the economical situation, the impact on value of a minority interest. So if you are a 30% owner, you don't have the ability to force liquidation or distributions. You may be in a situation where there's some compensation structure that favors the controlling owners. You may not have the ability to influence decisions that are being made, whether it's to explore a new product line, whether it is to make an acquisition, or to discontinue a product line. Sometimes there's situations where the company you may have multiple service lines and one is not profitable. And the only reason that service line is continuing to be offered is because it's the pet project of the controlling owners. In that case, that devalues the company and a minority owner can't do anything about it. Now, so that devalues the minority interest. And that's kind of what we're talking about in that lack of control. That lack of control not having the ability to make those improvements and changes to increase the value of the company. Oftentimes we see that the exact ownership interest is what is being considered, and not necessarily the whether it is control or minority. And what I mean by that is you can have a discount, a interest that is more than 50%, but it's not control. And how that can be determined is if you're talking about a limited liability company that is manager managed, and let's say it takes 75% of the members to change the manager. If you own 55%, you don't have control. The manager has control, and at 55%, you can't change the manager. So there may be elements of lack of control in a 55% interest. Now, a 50% interest is a unique beast here. It's not really control, but it's not really minority. A 50% interest has the ability to block actions of the other owner if it's 50-50, and it can create a deadlock situation too. So sometimes there's advantages to being able to block the actions of the other owner, but then when you get into this deadlock situation, that may be very problematic and devalue the interest because of it. If we're looking at a 20 to 49% interest, they may not be able to control the company, but they do have some influence or may have some influence. They may be able to block actions if, let's say, remember that 75% interest I mentioned, needing to have 75% to change the manager in the LLC. Well, if you own 49% or more than 25%, you can block that major decision. Less than 20% is typically, we say that's minority. They really don't have influence. They don't have control. But what about a situation of a swing vote? And there is an IRS case out there. I believe it was there were 3 owners. One owned 49%, another owned 49%. The last one owned 2%. And that 2% was a swing vote because the two 49% owners repeatedly did not agree. And so that 2% swing vote actually had more influence than what we would typically expect. So the ownership and how that relates to a discount for lack of control, we really have to dig a little bit deeper into the ownership, the capital structure, the governing documents, and the voting rights. Some of the agreement provisions that can impact the minority risk is voting or veto consent. And this would be ability to block major actions, and it depends on the magnitude of the interest that we're valuing. Cumulative voting rights can also help the minority owner, as well as having those put rights. So a put right would be I can require the company to buy my interest. So in a situation where things are going awry, I don't agree with the direction the company is going, I can put my interest to the company and they have to redeem it. And typically there are specific provisions as to how the value is determined in that put situation. The appraisal rights in those agreements, typically they may have either a formula or a definition requiring how the company would be valued and the methodology. So, for example, it should be based on the minority non-marketable level of value determined by a qualified valuation professional. Or another example would be the value of the company should be determined without regard to any discounts for lack of control or lack of marketability and should be determined by a qualified valuation professional. Those are important things to look at because they will impact the magnitude or whether or not a discount even applies. There may also be some buy-sell agreement terms that have maybe either a contractual pricing mechanism or a process in which to determine the valuation. Now, that contractual pricing is, it's easy to understand, right? It might be a formula and say 5 times EBITDA or 4 times EBITDA. But where the problems come in is, what is EBITDA? What are adjustments after EBITDA? And so you have to be really careful with any kind of contractual pricing in a buy-sell agreement, making sure that it's clearly defined, that it accurately depicts the value of the company, and that it's routinely reviewed, because facts and circumstances change, and the formula may need to be updated to reflect those changes. Now, the common support for a discount for lack of control is these control premium studies. And so what the control premium studies do is they look at transactions that resulted in the buyer gaining control of the company. And by gaining control, the definition is more than 50% of the company. So in taking these control premium studies, you can convert that control premium to a discount using the formula on the screen. But further analysis is necessary to determine what is being included in these transactions. Are there synergies that are being included that we may need to eliminate if we're using a fair market value standard? So the using the control premium studies, we just have to be careful. I'm not saying don't use them. I'm just saying we have to be careful and exercise professional judgment, and make sure that we're looking at that information in more detail and not just using the average or median. You'll hear me say that a few different times. Don't just use the average or median. And so if you're looking at a valuation report and that's what you see, and the average or median was 35%, therefore that's what I used, you might need to ask a few questions about that. So in evaluating the discount for lack of control that was applied, it's important to know what the level of value was that the expert started from. And how we determine that is what was used to value the company. If it was an income approach and the cash flows are on a minority level basis, then using the income approach is going to result in a minority level value. You can tell the difference between a control level of cash flow and a minority level of cash flow by evaluating the adjustments that were made to the company's records. If you see things like personal expenses are eliminated, the owner's compensation was reduced from maybe a high level, because it was a C corporation, to a much lower, more market-based level of compensation. That would tell you that it was a control level of cash flow. If you don't see adjustments like that, typically it's a minority level of cash flow. There may also be differences in the capital structure that was used to value the company. If the company has no debt and you see in a weighted average cost of capital that some component of debt was used, maybe 25% debt structure, 75% equity, that might indicate that this was more arriving at a control level of value. We also need to make sure we're asking about the documents, the governing documents of the company, like the operating agreement or partnership agreement, or maybe a buy-sell agreement, and making sure that we have a full understanding, or in the valuation report, it's fully documented, an understanding of the rights that are specific to that owner. And the best discount for lack of control challenge is not typically a factual basis, but more theoretical. So kind of putting all of this together, you used a 25% discount for lack of control, but that ownership had a swing vote opportunity or a put right. Did you really consider that in that discount for lack of control? Now, discounts for lack of marketability are a little bit different, different aspect than control. So control is about the ownership interest itself and whether or not it has the ability to impact the operations and decisions at the company level. The discount for lack of marketability is more about, can the interest be sold? How long it would take to sell? What would the costs be to sell that interest? And then any uncertainty around buyer availability, pricing, maybe transfer restrictions. Those elements are also part of this discount for lack of marketability. It really is to price the economic burden of selling an illiquid minority interest. And in a minority interest in a private business, you think about what's the market for that? I mean, typically it's pretty small. It might be other owners in that business. It might be family members, but you can't go on the market and sell your interest. So it is not marketable. And it can take a long period of time to sell your interest, and you may not even be able to sell it. And so that's what this discount for lack of marketability is trying to capture. Some of the factors that impact the magnitude of the discount are whether or not the company makes distributions. Think about a pass-through entity. A pass-through entity, if I own an interest in a pass-through entity, what it means is the income from that pass-through entity is allocated to me and taxed on my 1040. Now, if that pass-through entity is not making any distributions, I have to continually pay those taxes every year, right? And I'm not getting anything back. So that would impact that discount for lack of marketability. Now, if the company is distributing pretty much all of the cash flow, that changes things, right? It could be the same company, but if they're making distributions, it makes it more marketable. If they're not making distributions, it makes it less marketable. Another factor that we don't always talk about is the financials, the financial picture. And are the financials that are available to the owners, are they reliable? And, we often think, well, gosh, they have a CPA prepare the tax return. Yeah, that's great. But what did the CPA do in preparing the tax return? Sometimes they make a lot of adjustments. And, so what that tells us is that interim financial data may not be reliable and reflective of the actual operating performance because we don't have those end of year adjustments that the CPA makes. In other cases, it may be a very limited scope engagement where they just take the financial data and prepare the tax return from that. In that case, there may be adjustments that weren't made that should have been made. So we really have to think about that financial picture and is it reliable or unreliable? Is there any concentration of control in the company where maybe there's one controlling owner that is really dictating everything that happens, and that can really impact the marketability of that interest as well? So the analysis needs to connect these factors together and not just necessarily list the factors and say, this increases the discount, this increases the discount. I've seen that before. There are factors that increase the discount, don't get me wrong, but there are factors that decrease the discount. And we really need to make sure that that all of those factors are being considered in determining the level of the discount. So from an empirical evidence perspective, there are two studies out there that are typically cited in valuation reports. And if you've seen one of mine, you'll probably see the restricted stock studies discussed there. Sometimes there might be some discussion of the pre-IPO studies. Those studies are typically, they've been around a long time, but are less relied upon nowadays. Restricted stock studies compare the price of a restricted share versus a freely traded share of a public company. And you can get a variety of studies of these restricted stocks, and they have a varying magnitude of average or median discounts. Just simply using the average or median discount is not the best way to go. You want to be able to analyze the information and make sure you're comparing it with other data in the valuation engagement to make sure that you're getting the right marketability discount. Now, for the restricted stock studies, there are some databases that you can search and perform additional statistical analysis on those discounts to see if we look for specific traits of the company, what are the discounts for lack of marketability that would be applicable under those factors. But you still have to be careful of that too, because if you pick, like, let's say we take revenue size or profit margin or discounts, you need to look at more than one factor or more than one trait in making this comparison, or you may end up in it with an unreasonable discount. So care has to be exercised when either using any of these empirical studies or in using the discounts. The empirical evidence, what it proves is that there are adjustments that are made for marketability and size, holding period, and volatility, and risk as well. But it does not prove the magnitude of the discount, right? It does just the average or the median does not mean that is the specific discount that should be applied in the specific case. So these study the populations in these studies may not match the subject company. Some of the restricted stock studies only have specific industries in them. And if you're valuing a company in a different industry, does that restricted stock study really apply to your specific interest? There are also regulatory changes. If you understand that restricted stocks, they've changed over time. It used to be a 2-year holding period, then it went to a year, and then there's 6 months. So, and it's kind of a, you can't sell it all at one point. You're limited on how much you can sell. But if we're comparing that holding period to our subject interest, and our interest is in a privately held company, I still can't sell my interest. It's still not liquid in 6 months, right? So there's still differences that have to be considered. So anytime you see an average or a median being applied without adjustment, without discussion, that discount may be vulnerable. So our quantitative models, these are option pricing models. And I mentioned this earlier in the webinar that the IRS is really looking for more details and a more rigorous analysis of the discounts. So we want to make sure that we are looking carefully at the market volatility and considering these options when we are valuing an interest for gift or estate tax purposes. We can't use them again. We're not going to use any study or any analysis blindly. We need to put it all together, and we'll talk about that in a couple minutes. How do we bring all of these studies together and all the different discounts for lack of marketability? How do we evaluate them overall? So from a quantitative model perspective, there are you typically hear of these 4 option pricing models: Chaff, Longstaff, Finnerty, and Shout. And each one has different characteristics. The Longstaff is typically looking at an upper bound liquidity value. The Finnerty model typically takes into account volatility, distributions, as well as the holding period and trading restrictions. The Chaff model doesn't incorporate distributions, but it takes into account the volatility and the expected holding period. And then the Shout option model is a little bit different. It's kind of an alternative option framework. So you don't always see that in the discussion of the discounts for lack of marketability. But these help to support the concluded discount. And we'll look at that in just a second, how we bring it all together to value these interests. Now, we were just talking about discounts for lack of marketability as they relate to minority interests. So what if we're valuing an interest that's more than 50%? And anything more than 50% can be considered a controlling interest, right? So we're not always just talking about 100% ownership in a company when we say a controlling interest. And there's some debate out there as to whether or not there's a discount for lack of marketability as it relates to a controlling interest. And that's kind of where we get into these nuances of, are we really saying discount for lack of marketability, or are we talking about lack of liquidity? And it's really lack of liquidity captured under that lack of marketability umbrella. And so it may exist when, the company needs to have time and cost and diligence to be able to even identify buyers. And there's some studies out there that talk about private companies that are offered for sale. They don't always sell. You may do your best, you may have a great broker, or you may be working with some great advisors to sell your business, but you just can't find a buyer, or you can't find a buyer that's willing to pay the value that you think your company is worth. So there may be a discount for that lack of liquidity, but the major studies that I talked about, those empirical studies, they apply to minority interests, not controlling interests. So if you see a valuation report that is using a discount for lack of marketability on a controlling interest and is citing those empirical studies, that's an issue. That's a vulnerability, and you definitely want to look into that a little more carefully, because control does improve the marketability. It just doesn't change the liquidity if it's in a private company. So some of the company-specific factors that we want to take a look at in evaluating, kind of putting our judgment around all of this. So we talked about empirical evidence, we talked about the option pricing models, and then there's the judgment that we need to exercise in determining the level of value. Or I'm sorry, the magnitude of the discount. So the company-specific factors, again, what is the condition of that financial data? What is the management depth? The size of the company, kind of the trend in the profitability. What are the concentrations? And you might see concentrations relative to, it could be a key person issue, it could be concentration with a customer. I had this one case where I'm not kidding, 95% of the revenue came from one customer. Talk about not marketable. That company was not marketable at all. They could not find a buyer because it was that 95%. And if something happened to that relationship, there goes the business, right? So that has to be considered. As well as, so those are the company factors. We also have to look at ownership factors, kind of the size of the ownership interest we're looking at, what type of voting rights. And speaking of voting rights, we talked about kind of the ownership percentage. Now, if you see that you're valuing an interest, it's a 5% interest. Well, you automatically think that's a minority interest. But if you don't look at the details of the capital structure and the rights associated with the specific interest, you may miss something. That 5% interest may be minority when you look at the overall outstanding shares, but it may be a controlling voting interest. So you have to make sure you're looking at the specific type of shares that are being valued and those shares relative to the overall. So if you're looking at shares that have voting rights, what is the percent ownership of the voting rights, of the voting shares that you're valuing? And that can help you to determine the magnitude of discounts if discounts apply. We also have to be very careful here in double and triple counting some of these factors. So concentration risk, we often see that addressed in cash flow and in the discount rate applied in the income approach, or adjustments to multiples in the market approach. So we want to be careful that we're not double counting. When looking at a judgment discussion of the so a judgment discussion of the factors that impact the magnitude of a discount, you want to look for things like, let's say we'll stick with the concentration risk. So the business has concentration risk with customers, with one or two customers represents a significant portion of the revenue. This would typically increase the discount for lack of marketability. However, the factors related to this concentration risk have been considered in other elements of the valuation. Therefore, no additional adjustment to the discount for lack of marketability is warranted. You want to look for wording like that or similar to that in the valuation reports. That's telling you that the analyst is aware that absent taking this into account in other aspects of the valuation, it should impact the discount. But because it was captured elsewhere, no additional adjustment is necessary. It's important that the valuation analyst has considered the governing documents. So sometimes there aren't any shareholder or operating agreements, and I get that. But if there are, it's really important that those be considered in determining the discounts and how they should be applied to the subject interest. The IRS will push back on too much impact being allocated to transfer restrictions. So you want to watch that, make sure that the valuation analyst isn't overly impacting the discount for those transfer restrictions. But there are other terms that definitely are going to impact, and that's like the put and call rights. If there's a put option, that creates a market. If there's call rights where the company can call the shares and buy them at any time, if that price is at a minority non-marketable level, that further supports the magnitude of the discounts. We also want to make sure that we have a good understanding as valuation analysts of the voting thresholds and what are the supermajority rules. They may be in the bylaws and articles of incorporation, they may be in the operating or shareholder agreement, but they may be state determined. So whatever the circumstance is, that needs to be addressed in the valuation report. So, typically what I want to do in when I'm looking at these agreements is make sure that I can have access to counsel to get an understanding. I'm not a lawyer, right? So I'm not going to be able to make a legal interpretation of a document. Sometimes the description is pretty clear, but other times it can be a little convoluted, and I need to get counsel's understanding of what the rights and restrictions are in that agreement and how they impact my valuation. Looking at distribution history and prior transactions, you would think that that is pretty obvious. We want to look if there's been other transactions in the subject interest or the subject company. But sometimes I've seen them actually ignored. And so you want to, if you see that there's been other transactions, you want to ask the valuation analyst, why didn't you consider these? Why did you exclude them? Did you even determine what the value would be under those same metrics? Just some good questions to ask the analyst that you're working with. So here's kind of the sequence. Sometimes people hear, oh, you applied a 15% discount for lack of marketability and 25% for lack of control. Actually, I said those reverse. 15% lack of control, 25% lack of marketability in the example. The combined discount is not 40%. It's a mathematical sequence. You apply one discount first, and then you apply the second discount. So that can be an easy check. Make sure that the analysts that you're working with applied the discounts in the correct way, and that they didn't just add them together and apply a 40% combined discount. So this is where we can get into that double and triple counting situation, where we have an issue with our forecasts or cash flow where they have low margins or low forecasts. And then in the discount rate, so we've adjusted our cash flow for that, right? And now we go to our discount rate and we say, you know what, we're going to put a high company specific risk here because of their low margins. And then we go to the discount for lack of marketability and we increase the discount for lack of marketability because the company has low margins. Well, if we did all three of those, we've triple counted that risk. And we only need to count it once. So we want to be very careful when you're looking at the valuation report and the analysis that you look for those factors to see, did they count this factor twice? I mentioned before customer concentration, that's one of them. But litigation exposure and thin management may be another one. And if those have been taken into account in the cash flow and the discount rate, they should not impact the discount for lack of marketability unless there's some argument that says there's an additional economic factor that has not already been captured in the other, in the cash flow or the discount rate. So here's a fact pattern. The company depends on one customer for 55% of the revenue. So in the cash flow, in the forecast, what we did is reduce the revenue growth and margins to reflect the customer loss risk. We may have even done a with and without that customer. So if we lose the customer, what does the cash flow look like and how long does it take the company to recover? And then the with the customer, and then do a probability weighting of those values. We may have done something with the discount rate. Expert adds a company-specific risk premium for the customer concentration. And now we get to the discount for lack of marketability, and the expert also increased the DLOM because the buyers are not going to be interested in that high customer concentration. So what part of the concentration risk, this customer concentration risk, has not been captured in the cash flow and the discount rate adjustment? If the analyst can't answer that question, then they may have double counted that factor in the discount. So what makes a discount reliable? First is starting with the correct standard and level of value. So the standard of value, fair market value or strategic value. The level of value, is it control? Is it minority? Is it marketable? Is it not marketable? Liquid, illiquid? That has to be clearly defined and applicable to the subject interest. Have to identify the specific rights and restrictions that are applied to that subject interest. And we need to make sure that the data or the empirical evidence that's being used is reliable and not just being used because it exists. The company's specific factors need to be tied to control or marketability. So we can't just take, again, those standards, the standard or median or mean averages of studies of discounts, whether it's the control premium study or the restricted stock studies. We have to be able to tie those discounts to the company's specific factors. And then we need to be able to take the empirical data, the models, and professional judgment and connect them all together. That's where we're really going to have a strongly supported discount. We want to, again, make sure that you're looking for wording and language that identifies that the valuation analyst has considered and made sure that they're not double or triple counting any of the risks for the subject interest. So some of the things to be looking out for in a subject report is if the discounts are based on experience. without explaining the data and the judgment that were used and how they connect together. I mentioned the mean or median study results, but then this is one I see a lot. There's no bridge from the empirical data and the concluded discount. And what I mean by that is the empirical data may say, you know, the restricted stock studies, for example, they're at the average discount for lack of marketability is around 24%. But I'm going to apply 30% discount for lack of marketability without saying why. There has to be a bridge. I have to say, okay, in these studies, this is what was happening with the discount. In this situation, these are the factors that are increasing that discount, and therefore the 30% is reasonable. If there hasn't been any consideration of a shareholder or operating agreement, maybe the valuation analyst didn't even ask for one, didn't even ask if one exists. Well, that's kind of a red flag. And then if they're applying a discount for lack of marketability to a controlling interest and relying on the restricted stock studies, that would be a red flag. You want to ask more information about that. That might be very difficult to defend in court. And then a sensitivity analysis can be really helpful in seeing how those discounts impact the magnitude of the value of the interest. And so a sensitivity analysis can be very helpful and is something that you might want to talk to the analyst about. It's not something that's typically in the valuation report, but it is something that would be in the work papers. So if it is for a litigation setting, these discounts, some of the things to keep in mind when you're working with either getting ready to depose an expert or kind of in cross-examination is looking at that level of value and what level of value resulted from the valuation method that was applied before any discounts. And then kind of looking at the data fit. Why are the studies that were used to support the discounts, why are they comparable to the subject interest? What drove the judgment of the magnitude of those discounts? And how does that relate to the data that was considered as well? Is there a connection? Was there any kind of overlap in the risk, that double or triple counting? That can be a key one to address in a deposition or cross-examination. And then that sensitivity analysis that I mentioned earlier. A final one is what documents were considered. There usually is a list of documents considered in the valuation report, and you want to be looking for the articles of incorporation, operating agreement, partnership agreement, shareholder agreement. Sometimes it's a stock purchase agreement. Regardless of the name, any agreement that impacts the rights of the interest that's being valued need to be considered in the valuation. So this is a typical sensitivity analysis that could be helpful in driving some discussions, whether it's for negotiation, for settlement, or maybe if it was an IRS valuation and the IRS is auditing it, to kind of look at in determining if there should be some settlement discussions or what the range of value might be in those settlement discussions. Now, that's if the IRS is only challenging the discounts. Obviously, we're isolating just the discount for lack of control and lack of marketability in this example. But you can see if the discounts are lowered by 5%, both the lack of control and lack of marketability, the value goes up. And so it's at 7.2 million. And this is, again, that $10 million value company. The base case that we've presented throughout the presentation of 15% discount for lack of control and 25% discount for lack of marketability, that results in that $6,375,000 value. Now, if the discounts were higher, obviously the value goes down. And so in this case, adjusting the discounts by 5% one way or another creates a range, results in a range of value of 5.6 million to 7.2 million. So that might be the area that you're looking at from a negotiation standpoint, where with the other expert or with the with opposing counsel. So from a practical perspective, want to make sure that in working with a valuation analyst that you can confirm that the legal standard of value should be fair market value or fair value, and that the correct legal standard was applied, and whether discounts are permitted. In some situations, there are no discounts unless there's some extenuating circumstances. And in some agreements, there are no discounts. So again, if the agreement says that, let's say it's a termination of a shareholder employee, in the termination that no discounts for lack of control or lack of marketability would be applicable, then they shouldn't be applied, obviously. But that involves collecting the specific governing documents and analyzing the governing documents to determine what those parameters are. Looking at the distribution history and asking questions. So this is one thing that you may see, especially if it's a gift and estate tax valuation of, let's say it's me. I own my company. I'm 100% owner. It's a pass-through entity. I'm, trying to avoid some payroll taxes, so I pay myself the low end of the market compensation, and I take high distributions, right? So now I'm going to sell some of my interest, or I'm going to gift it. Let's say I'm gifting 20% to somebody. Well, I'm no longer going to get 100% of the distributions, right? I'm only going to get 80%. So that 20%, that new owner is going to get that. I might reevaluate my compensation. So make sure that the analyst has considered that and talk to them about, okay, this has been the distribution history. Is there going to be any change to the distribution history after the transaction? On the flip side, it may be that the company has had high debt and they've been paying the debt off over time. And they're getting to the point that they're just about done paying off that debt or getting it into a more reasonable level. So they've not made distributions. But once that debt gets to a more normalized level, distributions are expected to occur. You have to have that conversation and get an understanding of that. If the analyst didn't do that, then they're missing something. And make sure that there's a bridge, again, from the empirical data to the selected conclusion. I saw one valuation recently that all the empirical data and analysis shows a 30% discount for lack of marketability would have been appropriate, and a 15% was used with absolutely no bridge. It doesn't mean the 15% was wrong. It just means it wasn't supported in the valuation report. So additional questions may need to be asked of that analyst. So kind of some final takeaways. Discounts can impact the outcome. Data and empirical studies is just the starting point for determining the level of discounts. The rights and restrictions of the subject interest matter. And you need to make sure that the conclusion is clear, supported, and free of double and triple counting risk. So we are at the end of the presentation. So if anybody has any questions, this would be a great time to ask them. And if not, I want you all to be aware that our next webinar is coming up in 3 months, October 22nd. It'll be at the same time, noon Central. And it'll be the tale of two experts, looking at a company through competing experts' lens. Here's a QR code that you can use to register early. We'll send out additional information about the webinar as we get closer to it, and you'll be able to register at that time. One of the things with our registration is if you know you can't make the webinar, but you are interested in a recording, go ahead and register and check the box that you can't attend, but you would like a recording. That way you will automatically get a recording of the webinar when it is available. So thank you so much for attending this webinar. Really appreciate it. Hope this has been helpful to you. If you have any questions, please reach out to me. I'm happy to answer any questions at any time. So thank you so much and have a great rest of your day.